You're listening to Carrie Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. Well, these past few weeks, we've seen a dramatic market turmoil. We've seen meltdowns. We've seen the mighty stocks, the Facebooks, the Amazons, the Apples have all fallen pretty far from the tree, pun intended. And what could you have done in anticipation of this? What should you do now? Well, Dr. Rufus Rankin is with us now. The site is sidepocket.com. You also find Dr. Rufus on LinkedIn. Hey, it's great to have you on. So you're an advocate, you're espousing tactical asset allocation. How does that work, and what good would it have done you the past couple of months?
That's correct. So tactical asset allocation could be thought of as a variation on the idea or theme of strategic asset allocation. The main difference is that we're updating our estimates of what the world looks like more frequently. So you can think of it as a dynamic way to select your portfolio weights rather than a more or less fixed one. So with strategic asset allocation, you kind of look at history, perhaps perform an optimization, select your allocation to stocks, bonds, and other assets, and more or less let it kind of sit, right? With tactical asset allocation, we are a lot more adaptive. So what that translates to in bear markets is most tactical asset allocation approaches will reduce their exposure to assets as they're becoming more volatile, as they are going into negative territory for medium and long-term returns, and will tend to be mostly invested in very safe harbor assets or risk-off assets when we're in a bear market or drawdown.
Okay, so as far as the model goes, the allocation method, does it take into account inflation? How does inflation figure into the allocation?
It depends on the model. So there are definitely models, and I'm speaking generally here, that use inflation data as inputs, but typically most TAA or tactical asset allocation approaches will focus more on price and price-related data. So actual price levels, recent returns, volatility of the asset. So it will most TAA models will usually automatically reduce exposure to assets that are being harmed in the case of rising inflation, and increase exposure to assets that are benefiting from increased inflation. So that's one of the features of TAA approaches.
All right. So going back to the turmoil we've had the past couple of weeks and the inflation that we've suffered through for the past year, really going back to March of 2020, but let's just say for the past year, what was your model getting you into? What was it getting you out of?
So again, speaking generally, I can't present an individual model, but this approach in general would have been increasing weight to some extent to assets like commodities in various forms, to TIPS perhaps, Treasury inflation protected securities, and reducing exposure, especially as returns have been coming down so sharply this year, to equities. So we probably would have seen an increase to those assets that are long inflation, if you will, probably a year ago or so. And we probably would have seen reductions in exposure to equities a little more recently than that.
Okay. So going ahead, what are you seeing in the market, especially with the whole Ukraine-Russia war? What are the tea leaves telling you?
So that's the great but also frustrating thing about tactical asset allocation as your main approach to investing is you're really setting up a rules-based approach to reacting to what the market is doing. So equities, S&P, NASDAQ, what have you, go into a drawdown, you react to that, right? Yeah. So it's not really a predictive approach. It's really a reactive, and adaptive approach to the market. So Rufus, could have a view on what's going to happen in Ukraine, but my portfolio would not reflect what I'm forecasting. It would be adapting to what is actually happening in the markets, if that makes sense. So it's frustrating that we don't, a lot of investments are based on themes or stories, but TAA is not based on that. It's kind of cold, hard-nosed, just looking at the data and adapting to that.
All right. So you're adapting to what happened in the past. How does that help you in the future?
Well, most of the time with these approaches, the main benefit is we're reducing reducing exposure to asset classes that are as they're becoming more risky. So if the risk is picking up a lot in equities or bonds or commodities, these models will adapt to that and reduce exposure or possibly get out completely. So the outcome of that, or the result of that, or the benefit of that, is you tend to avoid large bear markets and drawdowns. So you usually you have a very good upside capture ratio for broad asset classes, but a very low downside capture ratio for broad asset classes. So you're getting most of the upside and a lot less of the downside. So in any individual market, you can get the timing a little bit off, but you're going to get the main trend right most of the time. And that's where the success comes from. So it's not, I'm going to pick this asset class to outperform and go all in. It's more of, I'm going to, when things are really risky, reduce my exposure and lose a lot less so that I live to fight another day.
Okay. So your model, obviously it's data driven. What data are you looking at for each sector to help you arrive at the allocation decision?
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network. The information you need to thrive now more than ever.
Sure. So a very basic approach would be to look at returns and volatilities of asset classes on their own. So I have a simple model that looks at U.S. equities, U.S. credit, U.S. treasuries, and commodities. And I have a relatively fixed or equal weight allocation to each of those. And I'm just going to decide each month, for example, if I'm going to be long or flat that particular asset class. So in that case, I'd be looking at mostly at price. Is the price moving up? Is it in a positive trend? And that's usually analyzed by looking at smoothed moving averages of the price, or also returns of that asset class over the last few to several months. And so that's a very simple model, kind of the base case, if you will. There are more advanced models and we can use more inputs, but that's kind of the basic idea, just to give a general idea.
Okay. So relative strength, does that figure into this equation at all?
Yes, absolutely. So some models will focus on an individual asset class or sector, and that's really where a relative strength approach can add value. There's been a fair amount of research on these two kinds of momentum. So you have time series momentum, which is looking at what a single asset class is doing through time. And then you have relative momentum, which confusingly is often referred to just as momentum when you're reading academic research on equity momentum. But that can also be thought of as relative momentum, and that's looking at the performance of one asset class versus another, or one asset class versus a sector or a group of asset classes. What it seems, or what the research shows, is that this relative strength, aka relative momentum, does a good job of shifting into assets that continue to outperform, at least for a little while. So you can boost your returns a fair bit adopting a relative strength approach. The time series approach, that is where we're just looking at an individual asset on its own, does a very good job of reducing risk, especially by reducing exposure or getting out completely in drawdowns. So a combination, so that's a great question because most TAA approaches or tactical asset allocation approaches will use some combination of the two. So relative strength and time series momentum.
Okay, interesting. And how long have you been using this model for?
So myself and the founders of SidePocket have been applying models like these for well over a decade. So I've been investing in these strategies run by other managers and using these strategies directly for close to 20 years. And then my colleagues at SidePocket have been doing the same as well. But there's research on these approaches going back well over 100 years, in some cases 200 or 300 years. So momentum, just leaving aside relative strength, that is looking at the performance of assets relative to each other, and just looking at time series momentum, which is one of the key ingredients or inputs to TAA, there's a lot of academic research and evidence going back a few hundred years. It's one of the most studied features of markets out there.
Interesting. I wonder how they studied it a few hundred years ago. Were people buying corn and cows, and because that's where their assets were, real estate. There wasn't a lot of. I guess there were shares 200-300 years ago on the U.S. exchange that was nascent, and in the UK, right?
That's correct. And there are also futures markets in Japan, I believe, going back to the 1700s. So they have futures and equity and real estate and commodity data going back a few hundred years. And so some of these scholars have been very good detectives and gone and kind of combed through old dusty libraries and found very helpful data for researching this approach for a very long time. Which,
right.
I'm sorry.
Yeah. So there's that much data to go back and really back test it, huh?
Indeed. And it's really, I wouldn't hang my hat on that data, but it's very important to see that the same basic model works just as well 100 years ago as it does right now. And so that's what we'd probably call a very good out of sample back test, because nobody doing research now was alive in the 1800s. So to take a very simple model or a complex model and apply it to data that has not really been seen by anybody and still get very strong, solid results is a good indicator that this is something that is persistent in markets and has a better than average likelihood of continuing to work.
All right. Really fascinating approach to the markets. I guess time will tell how good it is, really. And if you want to find out more about it, the site is sidepocket.com, and you can sign up for the shortly to be released app. So you could do it right on your phone. If you got a question for Dr. Rufus, just shoot me an email, kl@carrylutz.com. Don't forget, sign up for your free newsletter on financialsurvivalnetwork.com. Rufus, it's been a pleasure. Thanks so much for enlightening us.
Pleasure is mine. Thank you.
Thanks for listening to Carrie Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.